Welcome to a video that I like to call the deep dive video. Please don't let this name mislead you, especially if you're watching any of my videos for the first time. I use this in a little bit different context. Every week I do a number of videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. What I do is at the end of the week, I go through all of the daily charts and I pick out those that maybe I didn't talk about at all, or maybe very much, because sometimes we can get some insight by looking at these charts. This is being prepared for Monday, October 2nd. The first chart that we look at is a chart of the VIX. Now, you don't see the VIX on here. It's invisible. What you see plotted on here is a 50-period exponential moving average of the VIX. Typically with the VIX, we use static numbers, 12 or so to the downside. When we get down to that level, that means there's not a lot of fear. And then 20 to the upside. That means that fear is getting rather extreme. Well, you can see by looking at this chart, we don't always stay within that range. Sometimes we have a higher range, sometimes a lower range. And so what we try to do over on the right-hand side, we see the VIX really starting to go down in the longer term, and we're trying to figure out, is the VIX starting to develop a new range? We have a lot of zero DTE trading going on. The VIX gets kind of skewed sometimes. And so we're just wondering if that's having a longer term impact. Another chart is the VIX, and then we take a 3-month average of the VIX and then do a ratio between the two. And we look at the red line here, which is a moving average, and that is having a tendency to go up as we've been seeing more fear increasing in the market. But we've been seeing this for quite a while. We hit this in about July or so when the market started to top out. And this has been going back up ever since we've been having some pressure in this market. Then we also look at another study of the VIX. This takes the VIX and then a correlation with the S&P 500, because sometimes we can get some insight from this chart that we're not getting from the VIX. When this really starts to spike up, this middle area, that just tells us that something weird is going on at that point. Well, right now we're getting a very low reading on this chart, so I haven't been using it. Then we also look at another kind of VIX study. This is called the skew index. The VIX is based on at the money options and see how they're moving. Well, we have the skew index, which is based on out of the money options. And sometimes we can get some insight from that. Typically, when we get up into this red area, that means the market is expecting some kind of a big move. When you look at other times when we topped out and started coming down, sometimes that meant a continuation. Sometimes it marked a top. Sometimes it marked a bottom. So we're not quite sure. People seem to think when you use this that we can figure it out. We really can't, because we get different kinds of signals. And so we have to use other charts in conjunction with this. But you can see right now we're getting more of a reading in the midpoint, so I haven't been showing this chart. Then we look at the move index, which measures the volatility of bonds. That's on top. We look at that with the VIX, which is the next chart down. That measures the volatility of stocks. And then I have the spread between the two and the S&P plotted down below. What I follow is really at the way bottom. This is the correlation between the move index and the VIX index, and they're having a pretty strong tendency to go in the same direction currently. We also look at the equity put call ratio. This is a daily chart, and the reason I don't show this is the last chart to update each night or morning or whatever the time is. And a lot of times when I'm getting ready to record, this chart hasn't updated yet, so I haven't been able to use that. We use some other equity put call studies based on 5 periods. Those seem to update right away, but this one seems to take a while to do that. We have a fear gauge. Sometimes I show this a lot, and sometimes I don't show it very much. Since we look at the VIX, and then we're also looking at other charts to see is fear going up or down, we can see right here that we're having a slight tendency to go up. I did use this chart a couple of times this past week, but when you compare it to the big spike that we saw during the COVID plunge, it's really making these figures right here appear rather muted. Then we look at the VIX index to the move index and take a ratio of that. And this is just showing that the VIX is having a tendency to go up more than the move index. Both bonds and stocks have been under pressure lately. And so that's why we're seeing the moving average continuing to go up. Then we keep an eye on volume. Sometimes I show this every day, but during the summer months, we really dropped off with volume. And we're still below average because A lot of folks are realizing that we're in a weak seasonal time right now, and so they're not getting involved in the market. Well, we're seeing a little bit of a pickup as we get through the end of September and into October. This just measures the rate of volume each day. We also keep an eye on where are we in comparison to the all-time high. That's way over on the left. We hit that in early 2022. Over here on the right, that's where we closed on Friday, and we're down 11.01%. Then another thing that's put out by StockCharts.com, and I don't think you have to be a member to do this. They've changed some things on that website recently, but they have a number of different alerts that we can follow here. And this is for the whole week. If it's red, it's negative. If it's blue or green, it's more positive. And we read this from the bottom up. It started back on the 25th and goes all the way until the 29th. And it looks not only at other indexes, but it looks at sectors and any kind of a technical event that happens. And it's kind of useful to know that because the S&P doesn't exist within a vacuum. Then we also look at 5 main indexes: the Dow, the S&P, the mid caps, the small caps, and the NASDAQ 100, represented by the QQQs. And StockCharts.com has another tool available where they rate it on an unemotional technical score, 0 being the lowest, 100 being the highest. The higher the score, the more positive an index or individual stock is looking based on technical analysis. Coming in first place is the QQQs, and it's been in first place for quite a while. This hasn't been all that helpful to us, even though we're getting a score in 93.2. But you can see over here, this is historically how these scores have changed. And we've gone down a little bit, but the market's gone down a lot more than that. What I'm attributing this to is that the Qs, represented as the NASDAQ 100, they've had a pretty strong year. And even though we've been pulling back, we're not doing a lot of technical damage to the charts. Now, you can see that as positive, but at the same time, you might be a little misled by going, oh, we've been pretty flat here with our technical score. Maybe that's something that I should consider. Well, you don't want to use this all by itself. You also want to look at it with some other charts. Coming in second place is the S&P 500. There are a lot of big stocks, the mega caps that are in the NASDAQ 100. They're also in the S&P 500. And as we've been under pressure, we've been seeing this decline, and we're coming in at 72.6. In third place is the diamonds, and that's the ETF attached to the Dow. And it's also been under some weakness lately, coming in at 53.2. Then we have the mid caps, which also have been under pressure, coming in at 45.7. And then in last place, the small caps, they've been under a lot of pressure as well, and they're coming in at 33.6. Then we have some short-term charts to look at. This is a 20-period double and triple exponential moving average. This is different than your regular moving averages. And how we look at this is when we're below this and declining, that's negative. When we're above it and advancing, that's more positive. Well, we've been in a pretty significant downtrend lately, and this is shorter term, and we already crossed below this, and we can see where the dark blue line crossed above the lighter blue line, or maybe that's a green line that it crossed above or below. And so we're not really getting a lot of useful information from this. In conjunction with that is a regular 20-period moving average. Now, I plot a simple and exponential moving average on this chart. We get slightly different readings when we use the different kinds of moving averages. And we're well below these 20-period moving averages now. And until we can get back up into this, I probably won't be showing this chart. Then I have another indicator that I developed a long time ago, and it was just within the last year or two that I came up with the name Boom Indicator. That's because we're measuring how far above or below is the current price in relation to the moving average. Stocks tend to not get far away from various moving averages, and when they do, they have a tendency to boom back to the moving average. Well, the reason I have this in the short-term section is the 20-period moving average. That's what we hit first. And we did get to an extreme reading this past week, but we're seeing that lessen just a little bit, and it's coming back more into a neutral category as far as overbought or oversold, but we're still negative here. Then the next one down is a 50-period moving average study where we drop below the midpoint and are declining. That's negative, and we're getting down to the midpoint with the 200-day moving average study. Then we look at some intermediate term charts. This is a 50 period double and triple exponential moving average. When the blue line is above the red line, that's more negative. And when both of them are going down, that's even more negative. And we're still quite a ways away from this, so I haven't been showing this chart. Then here's a regular 50 period moving average study, both exponential and simple, where we're below both of these. And until we come back up, these may provide overhead resistance, but when we get closer, then I'll start showing these charts again. We also look at a 100 period moving average. Right now, the S&P is dealing with the 200-day exponential moving average, which is kind of strange, but we're below the 100 period moving averages. And if we start to come back up, they may provide some overhead resistance. We also look at a number of different oscillators, and I haven't been showing these because some of them are almost extreme negative, but not quite there. And you'll see that as I go through this. We have a thing called the Chaikin oscillator, which has been showing some improvement over the last few days, but it's still below zero, so that's negative. Here's one of the other oscillators, the money flow index. It came almost down to this extreme negative reading and is starting to bounce up just a little bit. And the ultimate oscillator also came almost down to this extreme reading and then started to bounce back up. So we're seeing a little bit of an improvement with these oscillators. We also look at the Kopic curve. When the black line crosses above the red line, that's more positive. I usually stop showing the chart because we use this more for buy signals than sell signals. But when the black line crosses below, that's when this buy signal goes away. We also look at on-balance volume, which is pretty much a raw score of up volume if it's an up day, down volume if it's a down day. This was one of the very first technical indicators to be developed, but we look at this and see that we're below a declining moving average. So when you look at advancing volume and declining volume, it's showing that we are more negative. Then we have an intermediate term rainbow. I have a short term rainbow, but I've been showing that one quite a bit in the videos. The intermediate term rainbow goes from 50 periods up to 100. It's kind of cool looking with the different colors here, but we're coming down below the intermediate term rainbow. And the longer we stay below this, the more these lines are going to begin to roll over, and that's more negative. When I'll start showing this chart again is if we start coming back up into the rainbow itself. Then we look at standard deviation, and I use standard deviation in a little different way than what you see on this chart. This pretty much is like the average price over the last 10 periods. And we finally started to see some volatility. And this doesn't measure up or down. This just measures how fast is something moving. And we're above the moving average right now, showing an increase in volatility. We also have the Pring bottom fisher. When the black line crosses back above the red line, that gives a buy signal. We don't use this for sell signals at all. Then we have the Sean trend meter, and when it's in this kind of yellow, sickly looking area of color here, that's more neutral. And we have been going down, so this has more of a negative slant to it. Then the Connors RSI, which is like a regular RSI, where we look for extreme positive or negative readings. This is a bit more spastic, but we don't get that many extreme readings. We got one right near the latter part of September, but since then, if we're above the midpoint here, that's more positive. Right now, we're below it, so that's more negative. Then we look at the ease of movement, and there's really another thing up here on top. These are called equivolume bars. And of course, when they're green, that's positive. When they're red, that's negative. And the thicker the bar, the more volume went into that particular day or that particular bar. So that can give us some kind of a graphical representation of what's happening. When we're going down, we see a lot more red. When we're going up, we see a lot more green. Down below, we have ease of movement, and this tries to measure the path of least resistance. I don't pay attention to the 1 period all that much unless we get a real extreme reading. I follow the 14 period, and we're below zero, and we're starting to flatten out here. So it's showing some improvement, but it hasn't gone back positive, at least yet. Then we look at the vortex, and I mention this in every video, but I don't show the chart. When the red line's on top, we're negative. The green line's on bottom, that's also negative. When these cross, then that will turn back more positive. Then we have the mass index, and I was showing this every day for quite a while, and it tried to generate a signal here, but it was a little confusing as to was that a buy signal or a sell signal? Because when we get a signal and it drops back down below this red dashed line, it's looking for a reversal. Well, as this line was going back up, we were going down. But then as we started to go back up, we still kept going up with this indicator, and we never got that far above the blue line. So now I've just kind of dropped this as some kind of a signal. And we have the percent B. This measures when we go above or below one of the upper or lower Bollinger Bands on this chart. And typically we spend very limited time either above or below one of the bands. So when we do end up closing outside of that, that gives us an extreme negative reading, and it tends to not last for very long. Then we look at the RSI, and I have been showing this on and off over the past week. We're almost extreme negative with the RSI 14, and that's what most people use, but we're starting to come back up just a little bit, where we did get extreme negative with the RSI 9. Then it looked like we were coming out of this, so I dropped it off of our extreme negative list, but now it looks like it could be coming back down. Then we're also keeping an eye on the Ichimoku cloud. I was showing this for a long time because we spent quite a bit of time inside the green cloud. Well, since we dropped below that, I haven't been showing this chart unless we start to come back up, and then one of these areas in here could provide overhead resistance. Then we compare the S&P 100 with the S&P 500 just to see if they're acting about the same, and currently they have been. We did see more of a divergence when we were getting higher highs with the S&P 100, that's the big stocks, where we were going sideways with the S&P 500, and those are the things that we like to look for on this chart. We also look at this, and I use this a lot, and then sometimes I don't use it very much. This is the S&P 500, which is a weighted index, and then we compare that to an equal weight index of the S&P 500, and then take a ratio between the two. When this is going up, that means the S&P, the bigger stocks, because that's weighted, they're outperforming the rest of the S&P. When this is going down, that means that the equal weight index is actually leading things lower. Right now, we've been chopping around for the last few days, but overall, we're still seeing where the big stocks are outperforming the smaller stocks. Then some long-term charts. We have a daily special K chart. I talk about this in every daily video, but I don't show the chart. We're above the red line, and so that's positive. We don't get crosses on this very often. We crossed back in June, and it looked like things were turning more positive, and it is rolling over a bit, but it hasn't crossed over negative yet. Then we look at an anchored moving average going back to the all-time high, and we're well above this red line, so I haven't been showing this chart. We want to know how far are we above or below the 200-day simple moving average. When it's green, we're positive, even though we've been dropping back lately. Then here's a longer term rainbow going from 50 periods up to 250 periods, and we're right inside the rainbow. The longer we stay in here, you can see the shorter term moving averages are starting to roll over a bit. And then we take a weekly chart of the S&P on top, and then a weekly chart of the German DAX. That's their main index in the middle. And because sometimes they have a pretty strong correlation. When this bottom indicator gets up to a really high reading, that means they're going in the same direction. Right now, they're more in neutral territory and having a tendency to go in opposite directions. Then we look at a long-term moving average study, and this has come on and off the daily videos. I use mainly the 150 and the 200. I have a 50 period on here really just for reference. When we're below the midpoint and declining, that's negative, and we're doing that right now, but we're not getting any kind of an extreme reading, at least at this time. Then some support and resistance charts that we have. This is a chart that I, again, mention in every daily video, but I don't show the chart. What I did is I drew a trend line from the low that we set in June of 2022 to the October 2022 low. So then we have this line going here. And then I went to the all-time high and drew a parallel line. Earlier on in late spring, early summer, this was providing some overhead resistance. Well, we were able to break through that. And so I haven't been showing this unless we really start to decline and are in danger of coming back down to this trend line. Then we measure from the COVID low to the all-time high, and these are quadrant areas. We just take that whole section and split it up into 25% chunks. Now, that may not seem like that big of a deal, but this was providing some pretty significant overhead resistance earlier in the year before we were able to break through that. We haven't come down to this level yet, so I haven't been showing this chart. Then I take a 20-period simple moving average of the open, high, low, close. That forms kind of what I call a mini rainbow here. And when we're below this and the mini rainbow is actually going down, that's more negative. Sometimes this will provide resistance if we start to go up, or it may provide support if we're in an uptrend and pulling back. But we're far away from the rainbow right now. We're also looking at a 50-day moving cycle, or 50-day cycle, moving average cycle. Okay. Different cycles. You'll have people that have 18.23-day cycles and 29-day cycles. Over the last year or so, the 50-day cycle seems to have been effective. Now, if you go back and look where I have this marked, sometimes that marked the bottom, sometimes it marked the top, sometimes it marked a continuation. So we can't take this in isolation. We had a new cycle that was started on August 1st, and that's what we're dealing with now after we were really going up well. And that's right about the time we started to see the market run into some problems. Well, we're going to have a new cycle on October 11th. We still have a little bit of time left in this. Are we going to see some kind of a shift when we get to that new cycle? Some broad market measures. This is the Vixen. This is the VIX of the NASDAQ 100. You can see it looks like icicles hanging off the roof here. I mainly look at the line chart where we are seeing a bit of an increase in fear as the NASDAQ 100 has been under pressure. Then we take another study. We have an equal weight ETF of discretionary and an equal weight ETF of staples. And then down at the bottom, we take a ratio between the two. And the fact that discretionary is outperforming staples is positive for the market. And even though we've been chopping sideways quite a bit, we are seeing some recent strength lately. So that's more positive. Then we have a weekly chart of the QQQs as represented as a representation of the NASDAQ 100, and then an anchored moving average going back to the all-time high. We are well above this, even though we've been under pressure here, so I haven't been showing this chart. We're keeping an eye on banks where they've been under a lot of pressure going back to March when we had the banking crisis hit. And we're just wondering, is something else lurking in the background that will happen? Well, we continue to be under the moving averages here, and we're in a longer-term downtrend. We also look at another ETF of the regional banks and compare that to the financial sector. And even though both have been under a lot of pressure, well, the regional banks are even underperforming the financial sector. Then we take a ratio of the QQQs to the diamonds. And then what I mainly look at is the correlation down here on the bottom. And they were going in the same general direction. Now we're seeing that relationship starting to lessen a little bit. Then we look at the Dow and the transports. The transports are the red line. And when they're underneath the black line, which is the Dow, that means the transports are underperforming. In a good solid environment, we want to see the red line above the black line. Then I also mentioned this, but this has gone on now for, my goodness, a couple of years. We take a cumulative look at the new highs and new lows for the NASDAQ. And you can see that cumulative figure is just continuing to decline. That's negative longer term. Then we have a raw score where we take the new highs minus the new lows each day. And when we're below zero and declining, that's more negative. When we're above zero, that's positive. So this chart is quite negative currently. Here is the financial sector. Even though it's been under a lot of pressure, we did generate a recent golden cross. Some rate of change charts. This goes from right now and then looks back 250 periods and then says, okay, where are we now in relation to where we were then? And we're continuing to show some improvement. And then I have a longer term look at that same chart, just showing how things are still improving longer term. We'll keep an eye on some bond charts. We have the S&P on top in red. And then the blue chart here is the long-term bond ETF, known as TLT. And they're having a fairly strong longer-term relationship. We saw that get out of line here to late spring, early summer, but now they're having a tendency to go in the same direction. Also, when we look at a 10-period correlation, their shorter-term relationship is also having a pretty strong correlation right now. We look at different yield curves. The ones that are mainly important to the market are the top two, the 10 to the 2-year and the 10 to the 3-month. We still remain inverted. There's a couple other yield curves that we follow. Looking at the 30 to the 5-year, we've actually gone back to being positive on this chart. Then we look at bonds and compare them with stocks. When this is going down, that means bonds are underperforming. Well, both have been under a lot of pressure lately, but we're seeing a little bit of a tick up in bonds as stocks have been under greater pressure. Then here is a value to growth ratio, which is the black line. And then we have the 10-year yield, which is the red line. And we look at the correlation between the two, and they're kind of neutral. They're having a slight tendency to go in opposite directions. Then we look at the Qs to the long-term bond ETF, and they're having a pretty strong correlated relationship, meaning that as bonds have been going down, the QQQs have been going down also. And then we look at an equal weight ETF, and then we have an inverted version of the MOVE index, and showing that the correlation between the two is quite strong. I'm still trying to kind of figure out this chart because the MOVE index hasn't been around that long, and so there's not a lot of historical data, but I'm trying to figure out if this is really telling us something or not. And then we look at the yield of the 3-month on here, and we're well above where we were back in 2007. And I mentioned this in every video. We're still going up even more than that right now. What we're waiting to see is, are we going to roll over and come down? And is that going to give us some kind of a warning sign? Then we look at the 1 to 3 month T-bill, which is pretty much cash, and we compare it with the 3 to 7 year bond. And when this was coming down, it looked like, okay, maybe interest rates are going to start coming down too. Well, we saw a real shift back, and this just continues to go higher. Then we look at TIPS, which are Treasury inflation protected securities, and we compare them with the 3 to 7 year bond. So this is suggesting that there's not a lot of fear about inflation right now. If this was really going up, that means people were favoring TIPS over the 3 to 7 year bond based on price. But when we look at the next chart, we look at TIPS and then we go further out with bonds. We're seeing that people are more concerned about inflation. And so we're seeing this ratio continuing to go up, which is kind of what the market has been dealing with lately. And then I have a number of things called possible positive scenarios. This is when we get near a major bottom and we see a convergence of a number of different signals together. Some of these we use day in and day out to measure growth versus value, where others we're looking for either extreme negative readings when we're going down or extreme positive readings when we've been going up. Here is some growth to value studies. We look at the Qs compared to the SPY, where it's having a tendency to be above its moving average. And longer term, it's been going up, but we've been going sideways quite a bit lately. Then we look at discretionary against the S&P, where it's starting to come back up to its moving average. We look at large cap growth versus large cap value, also seeing a bit of improvement. Then we have some growth to value ratios with the large caps showing some improvement, a little bit more improvement with the mid caps, and we're just a little bit above the moving average with the small caps. So we're seeing a little bit of improvement in these charts. Then we have the 10-day average of S&P 500 highs minus the lows, and we use this like an oscillator for an extreme positive or negative reading. When we're below 50 and declining, that is more negative, and it's not giving us an extreme reading right now. Then we take a look at the Amex, NASDAQ, and NYSE, a really broad measure. And then we look at a 5-period moving average of their highs minus the lows. When we're below 0 and declining, that is more negative. Then we look at the stocks in the S&P 500 and what are their 200-day moving averages doing. When we're below 50 and declining, that is more negative. Sometimes we can use this like an oscillator for an extreme positive or negative reading. Then we look at a 50-period exponential moving average of the new highs minus the new lows. We're showing a little bit of danger here, where we had been going up as stocks were going up. Lately, this is really coming down. It's still above 0, but it's in danger of dropping below 0, and that would be a longer-term negative signal. And I get the previous chart from this chart, where the black line is the indicator, and then the red line is the 50-period moving average that I use on the previous chart. And this is starting to come down and in danger of going below 0. We look at the S&P 500 with their 50-day moving averages, and this is also showing some weakness. We also look at the mid caps, which are pretty negative right now, and then we look at the small caps, which are also negative, and none of these are really giving us an extreme reading currently. Then we look at the 2-year Treasury yield. Sometimes when this has really been going up and spikes and starts to come down, that might give short to intermediate term support to the S&P. The problem is the 2-year yield keeps going up, so it hasn't really topped out yet. So thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I post. I hope you have a very good weekend, and I will talk to you in the next video.